excited to be here with you today because I'm super excited to share why Resolution Capital's Global Listed Infrastructure Fund is well positioned for tomorrow. Recently, there have been some very large fundraisings in the unlisted infrastructure space. For example, KKR raised $6.4 billion and Brookfield raised $30 billion. In 2022, a total of $175 billion was raised by sophisticated investors to invest into private unlisted infrastructure. However, governments are still doing most of the heavy lifting. G20 governments budgeted a total of $1 trillion in 2022 to invest in infrastructure. Now, demand for essential infrastructure is growing very rapidly. McKinsey estimates that the needed annual spend to keep up with this is actually over $3.5 trillion. At a time when government balance sheets are very stretched and the economy's needs are rapidly shifting, for instance, we need to be more connected, more decarbonised, have more recycling of waste, and even more clean water. So at Resolution Capital, we believe that this infrastructure investment gap is a compelling opportunity for investors, and the listed market is an ideal liquid way to access profitable opportunities in this thematic. Today, I want to highlight why the core infrastructure characteristics are very attractive, the secular tailwinds behind this defensive growth asset class, and finally, why valuations today in the sector should provide compelling returns for the future. Resolution Capital was established in 2004. We have a very long track record of investing in real estate investment trusts. In 2019, we entered into real assets, including infrastructure. We launched our global listed infrastructure strategy 2.5 years ago, and we're very pleased to say that thanks to investor interest, we'll soon be launching a currency hedged share class in addition to the existing currency unhedged share class. The investment approach across real assets is consistent. We have a simple philosophy for both property and infrastructure. We have a bias to quality assets. We look bottom up for solid underlying assets. And then we also look for capable management teams with skin in the game and appropriate financing structures. So why infrastructure? Global listed infrastructure has delivered stronger total returns of 2% above global equities in total returns with a lower volatility since 1999. And you can see that over time, compounded. This is very powerful. Performance has really been driven by consistent and stronger earnings. Infrastructure has been able to deliver this because fundamentally, these are monopolistic assets. They are assets such as water utilities, airports, mobile network towers. With such high barriers to entry, they typically have very strong pricing power above inflation. And these are physical assets that are critical to society functioning. So demand is very, very resilient. And within this core infrastructure opportunity set, we look for underappreciated upside, and we find that this is often driven by long-term thematics. Our portfolio is driven by three key themes: decarbonisation, mobility, and digitisation. 58% of our portfolio is driven by decarbonisation. We invest in electric utilities, renewable energy generation. With COP28 targeting a threefold increase in our renewable energy generation, opportunity is actually accelerating. 23% of our portfolio is driven by mobility, and this is the mobility and the movement of people and goods. Demand typically grows at above GDP levels, and within our portfolio, we invest in airports, toll roads, and railroads, which take advantage of this tailwind. And finally, 11% of our portfolio is underpinned by digitisation. Mobile network towers and fibre networks are the critical physical assets which support the movement of data, and our appetite for data is insatiable. So the mobility thematic underpins one of our key portfolio holdings, Ferrovial. Ferrovial is a 27 billion euro market cap toll roads and airports owner-operator. And over half of our valuation in Ferrovial is in a toll road in Toronto, the 407, which is pictured here. Toronto was ranked the third in terms of having the worst congestion globally last year. It takes about half an hour to just travel 30 minutes. In Sydney, it's 21 minutes, believe it or not. And the 407 benefits from this and captures this in two ways. Firstly, there's volume, and secondly, also pricing, because they have the flexibility to set prices as they see fit. So you can see in the blue line, the growth in tolls, which over the very long run has outpaced inflation shown in the red line significantly. But then COVID hit, and in Toronto, this had an unparalleled impact to traffic, given there were stay-at-home orders, so traffic basically stopped. With the recovery of traffic well on the way now, 15% increase in tolls was actually announced for this year. So we see for this asset an inflation catch-up, as well as an ongoing benefit from the 2% average population growth in Toronto. Ferrovial also owns some other high-quality assets, and one of the key underappreciated characteristics of this stock is that they have the ability to develop new high-quality transportation assets in North America. So aside from the high-quality assets and the management capability, we see that there's a very sustainable long-term growth profile for Ferrovial, and this is not currently appreciated in the share price. A newer portfolio holding is Dominion Energy. It's an American utility with about 37 billion in market cap. Northern Virginia has the most amount of data centers in the world. In fact, there's about a quarter of the world's data center capacity in this area. And 70% of the world's internet traffic actually goes through these very data centers. Dominion is the monopoly electric utility in this area. So we're seeing a rapid acceleration of electricity demand driven by AI. Dominion also benefits from decarbonisation and electrification. So this portfolio holding of ours, we see a very long 7% consistent runway of growth well into the long term because it's driven by decarbonisation and digitisation. Valuation for Dominion is also very appropriate and reasonable at this point in time on various metrics, including a 6% dividend yield. Now, more broadly across the global listed infrastructure space, we find that valuations have reverted back to a long-term average. And this is a long-term average that includes the very exceptional circumstances that was the GFC. And we think that the outlook for the sector is very strong. New investments are being made by these listed infrastructure companies, and these new investments are expecting higher returns than we've seen for quite some time. There is some real impetus to close some of that infrastructure investment gap that I talked about in the beginning, and this is partly leading to why the returns on offer have actually improved. So the global listed infrastructure asset class is backed by real assets with stable demand, and these revenues are typically linked to inflation. We think that carefully selected investments can provide a steady return over the long run. For our global listed infrastructure strategy, we have utilised our differentiated investment process to put together a select portfolio of less than 40 stocks, and these investments have very strong barriers to entry and that are difficult to disrupt, and they benefit from the long-term tailwinds of decarbonisation, mobility, and digitisation. The forecast dividend yield of our portfolio right now is about 4%, slightly higher than the average 3% that's provided by GLI, or Global Listed Infrastructure, over the long run. And we seek the average growth over the next 3 years on an underlying basis to be 9%. And this is driven by two factors. Firstly, 86% of our portfolio has inflation pass-through, and some of the effects of the past 18 months are still yet to flow through. And then secondly, there is solid real growth driven by the underlying secular tailwinds. And this is for this forecast period and well into the future as well. The Resolution Capital Global Listed Infrastructure Strategy is well positioned for tomorrow. It is a portfolio of simple, low-risk assets that will compound above inflation growth. Thank you.